Hello, I'm Chris Pedersen and this is Stock Watch on Thursday, 6th of June, 2024. All information is general advice and may not be suitable for you. Always consult your financial advisor before making any investments. All questions for viewers should be sent to stockwatch@fnn.com.au. A few market observations. Well, one, our markets are performing extremely well. We're in June though, which is often a down month. One down month does not make the start of a new bear market. However, when the market drops, it is usually opportunity to buy companies on the cheap. Develop an investment philosophy and stay with it. Do not jump on every bandwagon. GDP came in a little on the low side. This is a worry we need to keep watching. Aussie bank deposit growth. Well, this chart shows that banks are doing just fine on getting deposits. That's important because they need them to lend money out. And this is who wants to borrow the money. This chart shows Aussie credit growth. What you find that is fascinating is the blue line at the bottom is consumers and their demand for credit. It is skyrocketing. It's not quite as high as other sectors, but consumers are borrowing. Here is crowd scores by sector in the ASX 200. I'm not going to go through each one. You can do that. But what this means is these are the sectors that institutional investors and retail, but mostly insto, are most invested into. The far left, which is very heavily invested, are utilities right now. Obviously, this changes over time, but it gives you a sense as to where the smart money is investing. The ASX 100 most crowded long trades right now. So these are the longs that are most heavily invested in. Obviously, if everybody invested, the share price would be going through the roof, but it is a good indicator as to what companies are popular. Now, this is the ASX small ords and which companies are the most popular right now. This was a chart that really has nothing to do with the financial markets, but I found it interesting, and it deals with the United States. This is use of marijuana versus alcohol. Well, surprise, surprise, more people are now using marijuana than alcohol in the States. I actually find that simply amazing, but nonetheless, it is what it is. And this is another chart that's interesting because it deals with inflation. This is fast food prices versus hourly earnings. What you see is recently, fast food prices have gone up faster than hourly earnings. That tells you why fast food companies are more profitable than they have been, but it also is a worry because consumers are very price sensitive when it comes to fast food items. Three companies today I wanted to share with you. The first one is JB Hi-Fi. Code on the ASX is JBH and it's trading around $58.50. This is a 5-year chart. Taking a look at it, the stock has been meandering along and then has spiked up. So really the question is, should JB Hi-Fi be going higher or is it overpriced? Let's take a look at the numbers. First off, market cap is a little over $6 billion. Price target, well, UBS has a price target of like 51. Citibank has a price target of 57, 58. They're all over the place. The price target I have of 55 is really like an average of major investment banks. The revenue growth from 2023 to 2026 estimates is only 1.8% per annum. The EPS growth in this period is negative 8% estimated, and the dividend growth is also negative 8% estimated. The PE on the estimated 2025 earnings per share of $3.75 is 16 times. And the yield on the 2025 dividend estimate of $2.45 is 4.2%. Free cash flow is outstanding at a little over 7%. Payout ratio is 65%. So JB Hi-Fi, most of you know the company. It is electronic goods retail chain. Historically, it has had very high growth. No more. I feel it's overpriced. The growth rate is too slow to justify its current price. I would avoid it. Second company is Judo Capital Holdings. The code is JDO, and it's trading around $1.30 on the ASX. This company has not been public for 5 years. It is a bank known as Judo Bank. They are specializing in small and medium enterprise lending. It came out over $2. It was very well received. However, as you can see, the market felt it was overpriced at that time. It has sold off continuously until recently. Now it's trending up. So the question is, will it continue trending up at $1.30? Is it cheap, or should it go higher? Let's take a look. First off, market cap is $1.4 billion. I have a 12-month price target of $1.60, and that's in line with a lot of other brokers. Revenue growth rate for 2023 to 2026 is outstanding. It's 16% per annum. You would expect this. It's a small bank and growing. Earnings per share from 2023 to 2026 is estimated to be growing at 28% per annum. That's outstanding. Dividend growth, well, it's still growing. They're plowing a lot of their earnings back into their growth. They pay no dividend. That is smart for a bank at this stage. Now, on the ratios, its PE ratio using 7.6 cents estimated earnings in 2025 is only 17 times. So you're buying a lot of growth for a low PE. The yield on the 2025 dividend estimate of 0, well, obviously 0. The PEG ratio, which I've covered before, which is really PE ratio divided by earnings growth rate, is 0.6. That is below 1. That says it is an attractive company to buy. The CTI, what that stands for, is cost to income ratio. I'm looking at the numbers 2024 for 25 and estimate for 26. They are 57%, 54%, and 45%. The significance here is that an organization can't go from cost to income ratio decline from 54 down to 45 in just 1 year. That is totally unrealistic. If the institutional banks are expecting this to come true, well, I'm not sure if they will actually be surprised when it doesn't happen. But nonetheless, the company is growing, but I would be suspect in the 2026 earnings estimate because the expense side is not realistic in my view. So as I've mentioned before, it's a new bank specializing in SME lending. It has a lot of promise. It has yet to deliver though. However, it's starting to look good. As a consequence, I'm neutral on it. I want it to have a little bit more track record of delivering earnings growth, and that really concerns me, the cost to income ratio falling so precipitously in 2026. The third company is Ramsey Healthcare. Code on the ASX is RHC. It's trading around $49. Yesterday it was $48.71. Take a look at the chart. It's been all over the place and it's been trending down. So that's a worry. Market cap is $11 billion. So this is a decent sized company. Price target I have is $57. Revenue growth from 2023 to 2026 is 7.2% per annum. That's decent. Earnings growth in that period is 36% per annum. That's outstanding. And the dividend growth is also strong at 24% per year. Now on the ratio basis, the 2025 earnings estimate of $2 gives you a PE ratio of 24 times. For a company with this future growth rate, 24 times is not overpriced. The yield on the 2025 dividend estimate of $1.10 is only 2.3%. That's fine. Free cash flow is 3.6%, and the payout ratio is 55%. Those are all good numbers. Ramsey Healthcare is a global hospital group operating facilities in Australia, France, and the United Kingdom. I rate it a buy, just because the chart is trending down. The fundamentals are showing otherwise, that it's probably bottom and should start to rally. I like the company. As always, if you want to learn more about anything covered today, send an email to stockwatch@fnn.com.au and direct your email questions to me, Chris Pedersen. I hope you have a wonderful and profitable week. Thank you.